feature interview for today, and technical trading is a world that is quite mysterious to many investors.
Tonight we're talking about Fibonacci patterns and how to use them when trading stock. To talk to us through this very, very unusual topic is the veteran trader and author Joe DiNapoli. Joe, thanks for joining us on Moneymakers.
My pleasure.
Mate, can you tell us something about Fibonacci numbers? People have talked about them for ages, but a lot of people don't get what they actually are.
Well, the whole concept of Fibonacci numbers and ratios, it's endemic in everything. It's endemic in nature, it's endemic in architecture, it's endemic in the shape of your body, the shape of your tooth. I mean, everything in nature, crystal formation. So therefore, if you know how to do it, you can take Fibonacci ratios, Fibonacci numbers, and again, if you know how to do it, you can apply it to the stock market.
But it's that mystery that people like you say, if you know how to do it, that really probably turns a lot of people off. But why don't you give us an idea of how it's relevant to the people who are investing in stock markets today?
What's interesting about what you just said is that when I first found out about Fibonacci ratios and numbers back in 1985, I wanted nothing to do with them for the same reason. This is just mysterious stuff that doesn't apply.
Hocus pocus.
Hocus pocus. But then, when I started actually using them and determined how to use them properly, this was back in 1986, it absolutely revolutionized my trading. Totally revolutionized my trading.
Okay, but some people would say, like, how in the hell does some mathematical, I don't want to use the word theory, but a mathematical relationship related to numbers determine the outcomes on stock markets, which are related to businesses and people and decisions by governments and interest rates? What's the link, Joe? Convince me that it's true.
Well, I'm really not in the business of convincing anybody.
Okay. Well, don't.
No, I don't. That's really up to the person involved. When you see these things work on a 3-minute chart, on a 1-minute chart, on a monthly chart, and you see them work over and over and over again, the convincing is automatic. I don't need to do it.
Okay, well, let's try and make it happen for the audience and me tonight. We've got some charts here. Let's kick off with the first chart.
Sounds good.
So, guys, can we bring it up? So what are we looking at here?
All right. This is the 1987 crash we had when the Dow was down 22% in basically just a couple of days. We had a 500-point decline. Now, the market condition back then closely resembles the market condition now in that we had extreme panic. Now, the thing I want to point out to your viewers and to you, the most important thing is that if you look at the 0.382 ratio, those marks on the chart to the right-hand side are DiNapoli levels, a subset of Fibonacci analysis. Okay. If you look at the number to the far right, that number was a 0.382 retracement from the 1932 depression low, and if you notice, that number actually held the market decline almost to the point. Now, that number was developed when the market was at its high, not when the market was experiencing the pullback. The whole idea behind this Fibonacci work is that it's a forward-looking indicator. You can develop these numbers ahead of time.
So it's like a window for people who understand to see what's going to happen. So 87 was, what you're saying, was similar to the 30s.
The market condition of the drop in 1987 is similar to the market condition of the drop today. We have in the markets today absolute, utter panic. I know because I trade these markets daily. And we had panic then, we have panic now. The point I'm trying to make by that chart was that the 0.382 ratio off the depression low held the market. Now, if we go to the next chart, you'll see the point of this. In the 1972 low, all these marks to the right-hand side, you'll see various numbers where you have that depression low. The market came down, and once again, the 0.382 retracement from the 1932 low held the market. Held the market in 2002, it held the market. Now,
so is the 0.382 retracement a critical thing that keeps coming up all the time?
Yes, and the fact that we have taken that from the major depression low has immense significance to people that trade the way I do.
Okay, so let's try and convert it for normal people who think all this is double Dutch in terms of what we're saying and what they're seeing. What's it mean for the market now? What would be your standout conclusions?
All right, the relevance is so obvious to me, I need to explain it because it may not be to others. Ahead of time, if you knew what to do, you could have actually found the low to the 1987 market drop.
Yeah.
Ahead of time, you could have found the low, and I did, to the 2002 market drop. Now, we have a similar situation today, and I want to show you the situation that we have today.
So that's the next slide.
Actually, that is a simplified version of the slide we just saw.
So next one?
Let's go to the one after that.
Okay.